Welcome to the first definitions of the budget theme. There are several types of accounting. The two most important types are management accounting and financial accounting. Accounting in general concerns a management control system that maintains a detailed level of oversight over the use of resources within a business. The information used in a management control system is based on a budget or other plan that is compared to actual results, with variances being reported to responsibility centers throughout the organization. Management accounting has therefore an internal, a planning and control purpose. Financial accounting is the process of recording, summarizing and reporting a company's business transactions of financial statements such as an annual report. The purpose of financial accounting is to give external stakeholders such as shareholders, lenders and public authorities insight in the financial position of a company. Annual reports are comprehensive documents designed to provide readers with information about a company's performance, also called accountability in the preceding year. The report contains information such as performance highlights, a letter from the CEO, financial information via a balance sheet, a profit and loss account and sometimes cash flow statements. It also has information about the objectives and goals for future years. A balance sheet is a financial statement that reports a company's assets, liabilities and shareholders' equity at a specific point in time, and provides a basis for computing rates of return and evaluating its capital structure. It is a financial statement that provides a snapshot of what a company owns and owes, as well as the amount invested by shareholders. The balance sheet is used alongside other important financial statements such as the income statement and statement of cash flows in conducting fundamental analysis or calculating financial ratios. As you can see, sometimes you have to find the structure. Usually on the left side you can find the assets, fixed and current, the things a company has got. On the right side you see where the money came from to get the ownership of the assets. 1. Money borrowed from others. Liabilities, and 2. Money from the owners of the organization itself, equity. Once the organization is in operation by selling products or services, it gets revenues. The cost of revenue is the total cost of manufacturing and delivering a product or service to consumers. Cost of revenue information is found in a company's income statement and is designed to represent the direct costs associated with the goods and services the company provides. Cash inflow is the money going into a business. That could be from sales, investments or financing. It's the opposite of cash outflow, which is the money leaving the business. A business is considered healthy if its cash inflow is greater than its cash outflow. For management accounting, an operating budget is used beforehand for providing insights in revenue and costs. A liquidity budget is used for insight in cash inflow and outflow. For financial accounting, insight is given afterwards by a profit and loss account, income statement and a cash flow statement over a certain time. This next to the balance sheet at the end of a certain time. To have insight in your profit, the revenue or income you receive from the customer needs to be deducted by all expenses or cost. This will provide insight in the result of doing business, a profit gained or a loss. As said before, there is a difference between revenues and the inflow of money. When the deal is made or the contract is signed, one can speak of a revenue. The moment the customer pays, that is the moment of an income flow. This is not always at the same moment. You can imagine that a lot of deals without getting paid will lead the organization into trouble. On the other hand, a cost is not always an outflow of money. The moment the payment is done and money is leaving the organization, one can speak of outflow. See the example in this slide. Revenue is $500 per month, but the inflow of money per month is different, as can be seen. Depreciation is an accounting method of allocating the cost of a tangible or physical asset over its useful life or life expectancy. Depreciation represents how much of an asset's value has been used up. Repayment is the act of paying back money previously borrowed from a lender. Typically, the return of funds happens through periodic payments, which include both principal and interest. Loans can usually also be fully paid in a lump sum at any time, though some contracts may include an early repayment fee. To provide you with an overview and summary of the explained terms, you can see in the slide which plans and budgets need to be created to give insight beforehand via management accounting and which sheets and statements need to be provided afterwards. Here you can see an example of a liquidity in and outflow. An important topic related to liquidity is the payment of VAT, the value-added tax. No revenues or cost but in and outflow. Important information concerns the topic of taxes. The tax you receive from the customer via sales you need to pay to the tax authorities. Tax you paid to the wholesaler. The business selling goods in large quantities and at low prices, typically to be sold on by retailers at a profit, can be reclaimed from the tax authorities. This is an example for a sports canteen. Please calculate for yourself the result to see if the topic is clear. Did you have the right answer? Check this out. The following example concerns measuring a break-even point. Read the different elements so you can do the right measurements on the next slide. TR concerns total revenues and is price times quantity of sales. TC concerns total fixed costs plus the total variable costs. These total variable costs concern quantity times the average variable costs. So, in a break-even situation, TR equals TC. Therefore, the price times quantity equals the total fixed cost plus total variable cost, in which the total variable cost again is quantity times average variable costs. This is the case study concerning measuring the break-even point for Marissa's restaurant located at an outdoor camping. How many pizzas need to be sold to break even? Here you can see the calculation. Did you have the right answer? Based on the annual report, you need to have an understanding of different ratios such as solvency ratio and liquidity ratio. Solvency and liquidity are both terms that refer to an organization's state of financial health, but with some notable differences. Solvency refers to an organization's capacity to meet its long-term financial commitments. Liquidity refers to an organization's ability to pay short-term obligations. The term also refers to a company's capability to sell assets quickly to raise cash. A solvent company is one that owns more than it owes. In other words, it has a positive net worth and a manageable debt load. On the other hand, a company with adequate liquidity may have enough cash available to pay its bills, but it may be heading for financial disaster down the road. Solvency and liquidity are equally important, and healthy companies are both solvent and possess adequate liquidity. A number of liquidity ratios and solvency ratios are used to measure a company's financial health. For the balance sheet, the most important ratios concerned with liquidity are the current ratio and the quick ratio. For solvency, you divide the equity by its total equity. For all three calculations, you can see how they are measured and which outcome is a healthy value. The profit and loss account and balance sheet also provide important information on, for instance, the profitability ratios such as return on equity and return on assets. Profitability ratios are a class of financial metrics that are used to assess an organization's ability to generate earnings relative to its revenue, operating costs, balance sheet assets, and shareholders' equity over time, using data from a specific point in time. For most profitability ratios, having a higher value relative to a competitor's ratio or relative to the same ratio from a previous period indicates that the organization is doing well. Ratios are most informative and useful when used to compare a subject company to other similar companies, the company's own history, or average ratios for the company's industry as a whole. The way that an organization's debt is taken into account is the main difference between return on equity and return on assets. In the absence of debt, shareholder equity and the organization's total assets will be equal. Logically, their ROE and ROA would also be the same. But if that organization takes on financial leverage, its ROE would rise above its ROA. By taking on debt, a company increases its assets thanks to the cash that comes in. But since shareholder equity equals assets minus total debt, a company decreases its equity by increasing debt. In other words, when debt increases, equity shrinks, and since shareholder equity is the ROE's denominator, its ROE, in turn, gets a boost.